The Federal Reserve is ramping up the battle against the fastest inflation in 40 years, approving a third consecutive 75 basis point hike. The central bank's benchmark lending rate is now at a new target range of 3 to 3.25%. Now, keeping in mind that the rate was set at near zero as recently as March. And this is the Fed's toughest policy move since the 1980s. Well, joining me now is the man who helped the Reagan administration tackle inflation back in the 1980s. I'm pleased to welcome back Art Laffer. Art, of course, served on President Reagan's Economic Policy Advisory Board from 1981 to 1989, and he was later an economic advisor to President Trump and was awarded the Presidential Medal of Freedom for his work. Art, great to have you back with us.
Thank you very much, Michelle. It's a pleasure.
All right, let's get into it. We've got Fed Chair Jerome Powell coming across very hawkish today, saying that his main message that he wants to convey is that officials are strongly resolved to bring inflation down to the Fed's 2% goal, and that they will, quote, keep at it until the job is done. Art, what is it going to take to get the job done?
Well, let me just tell you how we did it, how Paul Volcker did it in the late 1970s and early 1980s, when we had very high inflation. I think mortgage rates were 16, 15, 17%. The prime interest rate when we took office on January 20th, 1981 was 21.5%, Michelle. That's really high. What you have to do to really bring inflation down is to let interest rates seek their own level. Right now, if you asked yourself the question, what would it take to attract me to buy a 10-year government bond in this type of environment? You know, the yield on that government bond is 3.55% or something like that right now. I wouldn't buy a bond for 5.55% if it made me. I mean, to get me to be willing to buy that bond, I think the yield would have to be 10, 11, 12%. Paul Volcker let those yields go straight up. He did not like price controls or interest rate controls. He let the interest rate go way up to where it was, to all of a sudden made money tight in the system. That's the first part he did. It also reduced the balance sheet of the Fed dramatically, which meant that they didn't have the supply of money which would accommodate and supplant and let that inflation go. The second part of the project was you have tight money, and then you want to have an increase in the supply of goods. We had the tax cuts under Reagan, which increased output, employment, and production. I think I may have mentioned in this last time I was with you, Michelle, but from June 83 to June 30th, 1984, that's an 18-month period. I mean, a year and a half. U.S. real GDP grew by 12%. 12%, that's at an 8% per annum rate, which is Chinese growth rate. So we increased the supply of goods, we tightened the supply of money, and inflation just tumbled like a stone. You know, inflation is too much money chasing too few goods. We made it more goods and less money, and we brought the inflation down. This economy under Biden and Powell is doing just the opposite. They should have interest rates right now in probably the 7, 8, or 9% range, and they're not. They're raising them a little bit at a time, which is just not the right way. If you've got a bandage on and you want to take it off, don't take it off a little bit. Just rip it off and get it done with. They should have done that a long time ago, but they didn't. And the Biden administration should be very expansive in the production of goods and services so that we have less money chasing more goods, and that will bring the inflation down. So far, they have really not done that. They've just inflicted the pain, but they haven't gotten any of the gain.
Well, Powell is warning us that it's going to get a lot more painful. I hear you're advocating for supply side economics. It doesn't seem as though the Biden administration is going to heed that advice. And it's interesting that you mentioned Volcker, Art, because Powell used the phrase keep at it until the job is done. And that's actually the title of former Fed Chair Paul Volcker's memoir, Keeping at It. So to what degree do you think he can channel his inner Volcker here? I know you're saying we need much more aggressive rate increases. This is not what the Fed is saying. I mean, they're only projecting a 1.25% hike by the end of the year. What do you think needs to happen here? Can he channel his inner Volcker?
Well, he should try to channel his inner Volcker. The whole thing about Paul Volcker that made Volcker so wonderful was he let interest rates seek their own levels. And that made bonds attractive, so people would buy the bonds. The Fed didn't have to buy them and thereby create a lot of money. That's the real problem. And he has not done that yet. The Fed balance sheet today is a little bit less than $9 trillion. Now, when I think of a trillion, I try to figure out how many zeros it has. I mean, that's 12 zeros. I mean, that's a lot of, I think it's 12 zeros. I'm just joking. That's a lot of money. And that money sitting out there can accommodate any amount of inflation. If you look at the Fed balance sheet relative to GDP, it's grown fourfold. And that's just a huge amount of growth. He needs to really channel his inner Volcker and get the job done. Now, maybe he doesn't have control over the Fed, and maybe he can't do it for some reason. If he can't do it, then 75 basis points, but he'll have to do a lot of those 75 basis points to get up to where markets are living right now. And that's a very long period of a lot of pain.
So you think on the quantitative tightening side, there needs to be a much more aggressive approach. Clearly, the interest rate is just one tool that the Fed has at its disposal. The Fed is shrinking its balance sheet by only $95 billion of Treasury and mortgage-backed securities per month. So at this rate, the Fed's balance sheet would reach its pre-pandemic level only by June of 2026. So how aggressive do you think the pace of quantitative tightening needs to be?
Yeah, if it must be done, best would be quick. My view is you've got an inflation problem. Now, we had a lot of things happening that I'm sure are affecting the Fed's thoughts. For example, in the beginning, over a year ago, Michelle, you saw the inflation numbers picking up very rapidly. You remember that? And we had oil prices going up with spot commodity prices, lumber prices. And so the inflation rate was way higher than the core rate because you had all of these short-term product prices rising, and it caused the rate to get up. I think the CPI got as high as 9.1% year over year changes. I mean, 17%, I think, was the inflation rate in 1 month, the highest month. I mean, that was just outrageous. And then, of course, you see all of that reversed. So now the inflation rate has come down year over year. Spot commodity prices have fallen dramatically. I think oil went from $120 a barrel down to $90, $85 a barrel today. All of that has caused the inflation rate to look like it's much better than it really is. If you look at the core inflation, that has been rising steadily, and it rose last month just as well as the month before, that. There has been no real damage inflicted on core inflation. That's where the solution has to be found. And it's not there. They're not doing the right job. And until they do, you've got all of these economic problems that are going to flow from higher inflation.
Well, what would happen if, say, for example, the Fed came out with a bumper 1.5% rate hike the next meeting?
If they did that, and if they really meant it, I mean, that would probably do no more damage than a 0.75% rate hike, my view.
You mean in terms of market sentiment, it wouldn't be more detrimental? In terms of
real GDP, GDP output and employment. You need to combine this with tax cuts, which this administration is not going to do. You need to combine it with less regulations, which this administration is not going to do, to increase the supply of goods. But when you look at all of this, I mean, you really need to ask yourself the question. If you knew today, Michelle, if you knew today with perfect certainty, there'd never be any inflation again for the next 30 years, just today, no more inflation from the day on, what do you think would happen to stock market? What do you think would happen to production, to contracts, to all those wonderful things? I think you'd see the stock market go through the ceiling. I think you'd see the economy bounce back very nicely. Curing inflation is not causing recessions or downturns or depressions. Curing inflation is very good for the economy. It's not bad for the economy. And if you do it correctly, you don't have to suffer any of the consequences. Tight money and tax cuts are the way Volcker did it. And now you'll go back and ask me the question, why was there such a big downturn in the U.S. in 81 and 82? And that's what these guys are all looking at and all are going, ooh, look what Volcker did. He caused that huge downturn. Well, not true. What happened is that the president, when we passed the tax bill in 1981, we phased in the tax cuts. So the tax cuts did not begin until January 1st, 1983 in total. All right. Now, if you know they're going to cut tax rates next year, what do you do this year? You accelerate all of your expenses and you defer all of your income. So the real reason why we had the downturn in 81 and 82 was because of the phase-in of the tax cuts, not because of Paul Volcker. It wasn't Paul Volcker. It's the exact same thing that happened with John F. Kennedy, and we didn't have the inflation problem then. He phased in the tax cuts. We had the huge downturn in '62. Same thing that happened with Harding and Coolidge right after World War I. They phased in the tax cuts. So 1922 was the big depression year, a year after they started, and then we got the roaring 20s. So, there's no reason to believe that having stable prices is going to cause the economy to crash. There's no reason to believe that whatsoever. You and I both know that if there were no inflation for the next 30 years, the markets would soar and we'd have a great real economy.
Well, Jerome Powell is saying that where we are right now and what needs to be done to tackle inflation can only cause pain. He's saying that there is no painless way to bring down inflation. He also added, no one knows if this process will lead to a recession or how significant this recession will be. It depends on how quickly price pressures come down and if we get labor supply. Failure to restore price stability would mean greater pain. Now, assuming the Fed continues on the path that it has laid out and assuming the Biden administration also continues on the path that it has laid out, that is not taking the supply side economics approach.
No, it's not.
What kind of pain do you expect, Art?
Well, I would expect they will put in a lot of pain, to be honest. I think they will do that. But let me try to explain the supply side approach again. If you have a bumper crop in apples, if let's say the trees of apples produce twice as many apples this year as we expected they would produce, what would happen to the price of apples?
They would go down because of more apples, more supply.
Now imagine we have a bumper crop in the production of goods and services. Let's imagine GDP goes up by 20% in the next 6 months. Woohoo! What do you think would happen to the price of each unit of GDP? It too would go down. That's what these guys are trying to do, Michelle, and I hope I'm explaining it clearly because it's really very important, is they are looking, if the demand for apples goes down, okay, let's say we can get in there and crush all the apple demanders, all the people who want to buy apples, and just crush their incomes, crush it. What will happen to the price of apples if we crush the demand for apples? Mm-hmm. The price of apples will go down. There'll be the same amount of apples and less demanders, and the price will fall. That's what they're doing. They're trying to solve inflation by crushing demand. You don't want to do that. What you want to do is bring down the price of apples or bring down the price of goods and services by expanding the supply, not crushing demand. Now, what you want to do is, because we look at the price of apples in terms of dollars, all right, that's what we're looking at. What you want to do is increase the supply of goods, of apples, and reduce the supply of dollars, and you'll bring the price of apples down very nicely, and you won't cause a recession. You won't cause a depression. You won't cause high unemployment. It's just the way we did it under Reagan. And frankly, we had the booming economy and prices came banging down. It was just the right thing to do. And unfortunately, I can't get through to these people, but supply is just as important as demand. It's the scissors. You've got the demand and the supply together. Without either one, you can't cut paper.
I hear you, Art, but I don't think the Biden administration.
Now, would you?
I hear you. I understand.
Can you? Sure. Would you call Powell and tell him exactly what I said, and tell him you watch this podcast and doggone it, you'll see exactly how to do it. You'll see exactly how Volcker did it, and you'll see exactly how we stabilized prices for all those years of the growth period of Reagan and Clinton and all that until now. Now we have all of this spending and the money, and interest rates started to rise. The balance sheet of the Fed got big, and the inflation caught on, and then they've lost the entire lesson.
I would call Powell if I had access to him and pass on the message. I have a feeling you would probably have a better chance of getting through.
I'll tell you. Let me whisper the number to you.
But Art, assuming he does not get the message from me, from you, or from anybody else, and it doesn't look like the administration or the Fed is getting the message, what is this going to look like? Give me your outlook. How bad does it look?
I think it looks very bad. Now, we've had a very bad economy since 2020. I mean, the beginning of 2020. Now, we had the pandemic, very understandable. We had to suffer that. But then we never recovered back up to where we should have. We're now about 6-7 million jobs short of where we should be had we grown steadily and caught back up. We have not. We are in a secular stagnation. The first quarter was negative GDP growth. The second quarter was negative GDP growth. I don't know what the Fed number is today, but I think it's less than 1% growth for the the Atlanta Fed. We have a very sluggish growth now. That means that any tightening of demand would cause that to dip below zero and cause enormous damage to the output, employment, and production and the incomes of individuals. We think they're talk these big numbers like the unemployment rate and all these. Those are real people, Michelle. These are not fake people. These are people that go home and, cry. The guy loses his job. The guy has a suffrage of income. He feels depressed. He doesn't feel worth anything. He goes out and buys a bottle of scotch and he drinks it and then he beats the dog, or, it causes all sorts of maladies that creep through. To think of the bad economy, you really want to sit back and imagine what it would be like to have your incomes crushed, your jobs crushed, the price of your products rise, and then not being able to, interest rates, mortgage rates going up. You can't buy a house. It's a real honest to God person. These people at the Fed, unfortunately, think of it in big numbers like GDP growth. That's not where the feelings, the pains are. They're in people like you and me who really feel those suffering and the pains. And I just wish they'd extend themselves and try to put themselves in other people's shoes so that they can feel the pain. It's not just a word you flop off at a cocktail party. It's real people, and they need to do the right things, and they're not doing it right now.
Well, it's not just the Fed, Art. I mean, there's a big disconnect between fiscal and monetary policy here. Exactly. We have the Fed trying to reduce inflation. Of course, it's been late to the party behind the curve, but fiscal policy is only one aspect here. And we have an administration that's put out unprecedented stimulus and continues to do so, continues to spend. The so-called Inflation Reduction Act, that's just a slimmed down version of the Build Back Better bill with billions in spending on climate change initiatives. The administration just approving another $4.8 trillion of new borrowing.
There you go.
And we have a debt to GDP ratio of 123%. So there does seem to be a big disconnect here between fiscal and monetary policy.
Yeah, the Fed's trying to control inflation. The fiscal policy is trying to increase inflation. If I can just talk about how that stimulus spending works. Imagine if I gave you $1 million, free and clear. It's yours, Michelle. It's yours. Wouldn't you shout your friends a beer or a lunch or something like that? Hey, come on, I'll shout you a movie. Let's go to, you'd spend more. And then you sit there and say, I think I'm going to take a little vacation. I'm going to go out to Vegas. I'm going to have some fun. I've got all this money here. I might even quit my job for 6 months and go on a trip around the world, whatever it is. What happens with stimulus money is it causes people to spend more and work less. So it hurts the economy. And that's what all this stimulus spending does. That's why we are in a secular slowdown. Now, this administration has just done it in incredible. What you say of 123.5% of GDP is correct. That went up from 82% of GDP very recently. That's 40 percentage points higher. That's a double. That's a 50% increase in our debt to GDP ratio. That's unfathomable how much that is. We are paying people not to work, and we're taxing them if they do work. People are leaving the labor force in droves, and we're then pumping in huge amounts of money, and we wonder why we have an inflation and an economy problem.
Well, our President Biden says he's committed to fighting inflation, but he doesn't seem to grasp the fact that we have inflation at 40-year highs. In a recent interview on CBS's 60 Minutes, the president said that inflation was up just an inch. I want to play this clip for you and get your reaction.
Mr. President, as you know, the annual inflation rate came in at 8.3%. People are shocked by their grocery bills. What can you do better and faster?
Well, first of all, let's put this in perspective. Inflation rate month to month was just an inch.
It's the highest inflation rate, Mr. President, in 40 years.
I got that. But guess what we are? We're in a position where for the last several months, it hasn't spiked. It is just it's been basically even.
What do you make of that, Art?
Well, he's completely correct. But what he isn't correct about is how that happened. Now, as I tried to explain when we first started, Michelle, and how we had all those spot commodity prices rising rapidly, and that led the core rate. The core rate was rising, but that led the headline rate, the CPI, to look much higher than it really was. But then when all those prices, when oil hit $120 a barrel, lumber prices were way, way up, all of that started coming down. again, the core inflation was still just rising straight away. Now it made the actual headline inflations look lower. The problem is the core inflation, not the wiggles around the core. And that's what the president doesn't really understand, is the measure of inflation is correctly done year over year. But the reason we do it year over year is to eliminate these little months, one up, one down. If he'd have talked about 2 months ago, 2.5 months ago, the number was 17% inflation. Now, he didn't mention that one. We had last month was a little bit down. This one's a bit up, but that doesn't affect the core. Shelter and all these other things in inflation are continuing to rise, and they're not jumping around like this. They don't abide by Biden's comments at all. The core inflation is just boom, 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 day in, day out, while all these others go wiggling around it. You've got to measure it by the core rate of inflation. We're going to have those spot commodities come back up again and go down again. That's not where we're worried. We're worried about core inflation, the base inflation, which is being bid and being built right into the psyche of all Americans. What are we going to do, Michelle, when the dollar starts weakening? You know, the one thing, the most primary cause of inflation historically is weak countries have weak currencies and high inflation. The U.S. has a very strong currency, and it still has high inflation. Wait till that dollar weakens. Then you're going to see all hell will break loose.
Well, speaking of the dollar, it actually hit a 2-decade high today on concerns about escalations in the war in Ukraine. I know you're talking about a much longer term outlook there. And President Biden has actually also been blaming inflation on Putin, calling it a Putin tax hike. The Fed has also cited the war in Ukraine as a factor, which has certainly exacerbated the situation, but it's not the cause. And it seems that this war is about to intensify. President Putin ordering Russia's first mobilization since World War II, getting an extra 300,000 troops, warning the West that if it continued what he calls its nuclear blackmail, that Moscow is going to respond with, and I quote, the might of all of its vast arsenal. Putin was making these statements on a national television address. I'm quoting him here, saying, if the territorial integrity of our economy is threatened, we will use all available means to protect our people. This is not a bluff. And adding that Russia had lots of weapons to reply. Art, what do you make of this?
It's very scary. I mean, it's really scary. I hope we have provided an off-ramp for Putin to be able to get out of this and stop the war. The war has added to inflation, but much more seriously, the war adds to a very high risk factor for everyone on Earth. This is not a good thing. It's not just an economic thing. Wartime situations invariably lead to very high inflations for periods of time, and that is true, and that is happening. But much more seriously, it just adds to the inflation, the bad economy, and now we have a wartime risk in the United States, which is, to me, terrifying. I look at Taiwan, I look at Quemoy and Matsu, and the whole area around there, and we are facing wartime efforts everywhere in the world. Look at Iran, look at all of these other countries. Michelle, I know you were born in Israel. I mean, can you remember those days in Israel where everyone was there, where the Arab Legion came through? And I don't know, the Maccabees there and where the monument is still right between Jerusalem and Tel Aviv. War is hell. And, the faster we can end this war in Ukraine, the better we'll all be. And that's another issue totally separate from inflation, although it does have an inflation impact. But it's something that really scares me about this administration. I don't believe that Ronald Reagan as president would have ever seen anything like this happen. I don't believe that Donald Trump would have ever had anything like this happen. Biden is a weak president and has implicitly encouraged Putin to do what he did.
Well, Art, you in fact served under Reagan during the Cold War, where nuclear war was, of course, a major concern. Is the prospect of nuclear war being too lightly dismissed right now?
Yeah, well, I make it that these people don't understand. They don't have any concept of what a real war is. I mean, when you look back, I was born just before World War II. I had to live in Arizona with my grandparents while Dad was on War Production Board. It was terrifying. I mean, it was really, and we have the initial stages of what could be a war of that size. I mean, the Korean War was terrible. I lived through that. I lived through the Vietnam War, the Middle East, all of these things. But this one is a land war in Europe. I mean, a land war in Asia with Afghanistan was bad, but we got out of that. And I think Trump was going to get us out. And thank God, I think Biden got us out. But then he plugged us right into a land war in Europe. And that's not what's good for America. It's not good for humanity. We may win it, but whenever you fight, Michelle, you always lose. You may not lose as much as the guy you punched in the nose, all right? But you always lose. War should be a last chance thing, never allowed as a quick thing. And it's being run as a sideshow, and it's something very serious.
It is being run to many as a sideshow. And I don't think it's being factored in terms of potential economic impact if this war does escalate, even short of some kind of nuclear weapons use. How does this impact the economy if this war does escalate?
Well, it impacts the economy enormously. I mean, thank God we haven't committed U.S. troops yet to the situation. But if that happens, it'll influence families. Body bags will be coming home. I mean, you can imagine the number of body bags in Ukraine right now. I mean, it's just terrifying. It's already hitting our economy very, very much. But it can also hit us in a different way if this war keeps going and building up and extending. And Putin is like a rat caught in a corner. How are we going to get him controlled without getting him to throw the whole arsenal at us? I don't know. I just don't know how. But he needs an off-ramp. And yeah, sorry.
Yeah, he is mobilizing an extra 300,000 military reserves. He's really escalating the war here. Look, obviously, if we have some kind of nuclear war, it would be a much bigger problem. But given the state of the economy, if we do have some kind of major escalation, if we do have a different kind of black swan event even, what does the Fed do? I mean, is there any kind of capacity to handle any type of black swan event at this point?
The government can't control everything, Michelle. It can't. Government can't control all the universe and everyone's thoughts and everything. What Powell has to do is let markets do what they do best. It's solve problems. Let prices rise. That's what they're supposed to do in markets. When the demand exceeds the supply, the price is supposed to go up. If you keep that price from going up, you destroy all the supply side incentives of creating more of the product. So I would beg the Fed to get out of the business of controlling interest rates and let interest rates seek their own level. Then they should sell off the assets off the balance sheet, not at $2.57 a month. Make it a large buy where you set off $1 trillion a year and get those bonds out of the Fed's balance sheet back into the market so that interest rates can reflect what they should reflect. They should reflect the expected real return on capital over the maturity of the asset, and they should forecast the expected rate of inflation over the year maturity. The two together become the nominal yield. Bond prices should reflect the nominal yield over the period of maturity in a good market. That's where the signals really work. And, everyone talks about free markets all the time. And, free markets are never more important than during periods of crisis. They're not something that, the economy is fine and good. Let's use free markets now. Oh, my God, we're in a crisis. Let's control the market. Just the reverse. You never need free markets more than you do them when there's a crisis. And we are in a crisis.
Do you think that the markets are really pricing in an escalation of this war at this point?
I don't know. I think when I look at these markets, what I do is I take it back a year or a year and a half to the last peak, and then I take the real market. Now, if you do the real market, you have about a 10% cut of the actual market. So if you're talking about the Dow Jones Industrial Average, an additional 10% would reduce it by another 3,000 plus points on the Dow Jones Industrial Average. If you look at that, we have had a very, very severe decline in this market. And I don't think it's over, Michelle. I think as long as these people are spending $3 trillion by giving away student loans, as long as they're doing it by raising the rate every bit and not doing tax cuts and pro-growth regulatory policies, I think we're going to have a very long, dark period ahead of us. And I'm very sorry for it. But, I guess the only thing I can say is the good news is that, it took Biden to give us it took us Jimmy Carter to get Ronald Reagan. And God knows the wonderful president that will follow Joe Biden.
Well, here's hoping.
There is a lot of hope out there. And I have lived through so many of these. I'm 82, as you know, Michelle, and I've lived through a lot of this. And, never give up hope. It is a point, counterpoint movement back and forth. And, we will come out of this. It will come out. We'll solve it. God knows how much damage we're going to cause in the process. But when we do, we will have a very bright future for the U.S.
Art, let's be optimistic here, at least when it comes to Russia and Ukraine. If there is a diplomatic solution, if cooler heads prevail and a diplomatic off-ramp is provided for Putin to still save face and there is some kind of resolution to this conflict, and it happens relatively soon, what impact would that have?
That would
have
an enormously positive impact. If Putin said, I'll do a deal, I don't know what the deal is, it doesn't matter what the deal is. The war is stopped. It's over. It's done. The markets will skyrocket. And then it will give Powell a much greater chance to make mistakes and not do a lot of damage. And then we'll have the inflation coming down fairly nicely, I think, shortly thereafter. And I think it'll be really wonderful for the world if we can end this war in Ukraine. It is to me the one thing that bothers me about my children, my grandchildren, my great-grandchildren's future. A land war in Europe is not good for the world. Yeah,
certainly not good for the world and not good for your grandchildren, of which you have another one, as you told me off air. So congratulations on that.
I just had a son-in-law win the Senate race, this primary in the 17th District of Michigan. Wonderful guy, Yaley as I am. He's married to my daughter, a Green Beret, Special Forces, 7 years tour of duty, and loves my daughter, and my number 6, and expecting his third child. So I am ecstatic. I couldn't be happier than you can imagine. It's just wonderful.
Well, congratulations, and I hope your grandkids and your son-in-law are reading your latest book. I want you to quickly give us a bit of a highlight there. Your latest book, Taxes of Consequences, an Income Tax History of the United States. Give us a brief overview here, Art.
Yeah, well, what it does is it literally starts on 1913 when the income tax was put into effect. I think the 16th Amendment was passed, I think in 1913 in March or something, they put in the income tax. In 1913, it's the whole history. The rate went from 7% for a very small number of people in the first 3 years. Then it went up to 77% in 1918. Then we had a big depression. The Republicans won. They dropped it down to 25. You can trace the whole history. You find out the following things. Every time they've raised the highest tax rate on income earners, on the top 1%, every time they've done that, the economy has gone into the doldrums. Every time they've cut the highest tax rate, we've had a recovery and a boom in the economy. Every time they've raised the tax rate on the top 1% of income earners, the poor have suffered enormously in the downturns. The Great Depression, World War II, all of these periods have all been caused by huge tax rates, tax increases. And the last one I'll talk to you about here, just summarizing it, is whenever you raise tax rates on the top 1% of income earners, you collect less tax revenues from that 1%, period. These guys know how to shelter income. When you raise taxes and the economy goes down, their dividend incomes, their capital gains go down, and what they do earn is less, but what they do earn, they also shelter, and the revenues just do not come in. So it's a win-win-win to have a low-rate, broad-based, flat tax, which provides all people equally and gives the same incentive structure across the base, and you can provide prosperity and plenty of tax revenues for needed public services.
And you lay out the case very clearly and succinctly in your book, Taxes of Consequences. Art, thank you so much for joining us and breaking everything down for us.
Thank you.
Thank you. And thank you for watching Kitco News. I'm Michelle Makori. Keep it right here.